In 2009, General Motors, once the largest automaker in the world, entered bankruptcy after decades of dominance. At its peak, GM controlled nearly half of the U.S. auto market, supported by scale, brand power, and industrial reach. That dominance was built on high fixed costs, long product cycles, and dependence on continuous vehicle demand. Over time, the company accumulated legacy obligations, including pensions and healthcare commitments, that kept rising regardless of sales. To sustain operations, GM relied heavily on financing arms and constant volume, masking structural inefficiencies. When the global financial crisis hit in 2008, consumer demand collapsed and credit markets tightened simultaneously. Vehicle sales dropped sharply, while debt obligations and operational costs remained fixed. The company's balance sheet could no longer absorb the mismatch between falling revenue and persistent liabilities. What followed was not a sudden failure, but the exposure of a system that had been under stress for years, culminating in one of the largest industrial bankruptcies in history. In Detroit, Michigan, General Motors was formed in 1908 as a holding company consolidating multiple car brands into a single industrial system. The strategy focused on scale, acquiring companies like Buick, Cadillac, and Oldsmobile to dominate different market segments simultaneously. This multi-brand structure allowed GM to control pricing tiers, customer demographics, and production volume across the entire market. By the 1950s, GM had become the largest automaker in the world, supported by mass production efficiency and strong domestic demand. The company's growth model depended on high-volume sales, stable economic conditions, and predictable consumer purchasing cycles. To sustain expansion, GM invested heavily in manufacturing capacity, labor agreements, and nationwide dealership networks. These decisions increased output potential, but also locked the company into a high fixed cost structure that required constant sales to remain stable. Structural takeaway: GM's dominance was built on scale and volume, but that same scale created a system dependent on continuous demand to survive. GM's business model relied on producing a wide range of vehicles at scale while maintaining distinct brands across price segments. Revenue was driven by high unit sales, with profitability depending on spreading fixed manufacturing costs over large volumes. The company also depended on General Motors Acceptance Corporation, which financed dealers and consumers to sustain demand. This financing arm allowed GM to sell more vehicles by expanding access to credit, effectively supporting its own sales pipeline. At the same time, long-term labor agreements created significant obligations, including pensions and healthcare benefits for retirees. These costs were not tied to current sales, meaning they remained even when revenue declined. To maintain margins, GM focused on larger vehicles like SUVs and trucks, which generated higher profit per unit. Structural takeaway: GM's model combined manufacturing scale with financial support, but it created fixed obligations and demand dependence that increased systemic risk. Through the 1980s and 1990s, GM expanded aggressively by increasing production capacity and reinforcing its multi-brand lineup. Growth was driven by capturing every segment of the market, from entry-level vehicles to luxury models under different brand identities. The company prioritized volume over efficiency, ensuring factories remained active even when margins began to tighten. At the same time, GM invested heavily in trucks and SUVs, which delivered higher profits during periods of strong consumer demand. This strategy worked while fuel prices were stable and credit remained easily available to consumers. However, it also increased dependence on a narrow set of high-margin products that were sensitive to economic shifts. Global competition from more efficient manufacturers began to erode GM's market share and pricing power. Structural takeaway: GM's growth strategy maximized volume and short-term profitability, but it reduced flexibility and increased exposure to changing market conditions. By the early 2000s, GM's cost structure had become significantly heavier than its competitors, driven by labor, benefits, and excess capacity. Legacy obligations for pensions and healthcare continued to grow, regardless of how many vehicles the company actually sold. At the same time, multiple overlapping brands created internal competition, increasing complexity without improving overall profitability. Factories were operating below optimal efficiency, but closing them carried high financial and political costs. The company's reliance on large vehicles exposed it to fuel price volatility, reducing demand when conditions shifted. Meanwhile, its financing arm became increasingly dependent on stable credit markets to support consumer purchases. These combined factors created a system where revenue needed to remain high just to sustain existing obligations. Structural takeaway. GM's structure became fragile because fixed costs, legacy liabilities, and operational complexity limited its ability to adapt under stress. In 2008, the global financial crisis sharply reduced consumer confidence and disrupted access to credit across major markets. Vehicle demand declined rapidly as consumers delayed purchases and financing became harder to obtain. At the same time, fuel prices had recently surged, reducing demand for the high-margin trucks and SUVs GM depended on. The company's revenue dropped significantly, but its fixed costs and legacy obligations remained unchanged. General Motors Acceptance Corporation also faced pressure, limiting its ability to support dealer and consumer financing. With declining sales and restricted credit, GM's operating cash flow turned negative. The company began burning cash at a rate that could not be sustained without external support. Structural takeaway. The financial crisis exposed GM's dependence on demand and credit, triggering a breakdown in a system that required both to remain stable. As losses accelerated, GM's cash reserves declined to a level where daily operations could no longer be funded internally. Debt obligations, supplier payments, and labor costs continued, even as revenue remained suppressed. The company required immediate liquidity, but private capital markets were no longer willing to provide funding. To prevent a complete shutdown of operations, the U.S. government intervened with emergency financing. This support allowed GM to enter a structured bankruptcy process rather than collapse outright. Through bankruptcy, unprofitable brands were eliminated, assets were reorganized, and liabilities were reduced. Shareholders were largely wiped out, and the company was restructured into a smaller, more focused entity. Structural takeaway. GM's collapse was driven by a liquidity failure, where fixed obligations and declining revenue exhausted available cash, forcing external intervention and restructuring. General Motors emerged from bankruptcy with a reduced cost base, fewer brands, and significant government support to stabilize operations. The restructuring removed a large portion of legacy liabilities, improving short-term financial flexibility. However, the collapse revealed how scale without flexibility can create long-term structural risk. Dependence on continuous demand made the company vulnerable to external shocks it could not control. Reliance on financing systems tied performance to broader credit conditions beyond its core operations. High fixed costs limited the ability to adjust quickly when revenue declined. The bankruptcy also highlighted the systemic importance of large industrial firms to the broader economy. Structural takeaway. GM's failure demonstrated that growth driven by scale and fixed commitments can become a liability when conditions change, making adaptability critical for long-term survival.